Welcome to TradeTheMBI.com. This is John. This report is for the 2nd of January, and what better way to start the year than to recap where the year went. So if we go over here to the little white line, we have the start of the year, and this little magenta right there represents about where we started at the 4,000, I think it was a little more than 74. I think it was like 76, yeah, was the open. And you can see for early part of the year, we were negative, and then we made a huge run up by the late end of July, and literally just to the end of October, we were close to being zero for the year, and that it started right there in November. The spike that we're undergoing right now, which has led to wonderful highs, exuberance, perfect timing for a Santa Claus rally. Now, interestingly enough, when we look at positive extremes through the year, um, well, we go back early into February, right about there, no big deal. That's at the highs, so it's not as relevant. Uh, Secondary one, right about here, that got filled in pretty quick. And then the other ones that took place were also filled in by the end of the year. So what do we have left? Well, starting this run, at the very beginning of it, we have the lows right here, around 43. The secondary one a little bit stronger, because if you look down at the extremes here at the bottom of the screen, you can see the spike is a little bit stronger on the secondary one. So that puts that range low right there around 43. So significant differential, and that would be quite a bit. Now, can it take some months for those to fill? Absolutely, and can be quite a while in some cases. And when we look at our DOC, just now starting to see a little creep up of sign, but DOC red still well above the 13, 7.5 range here, which is elevated. But every time you get this reduction in steel, which way down, which is what caused some of that selling on Friday, the end of the trading period, when it pops back up above the negative 13.5, it's going to just result in another round of buy. So, relatively speaking, gives you a pretty clear idea. And yet, of course, we can see that there are positive extremes through all of these. And those will be the early targets whenever a defined sell signal comes in. But this range between the 76 and 100%, quite extreme. And usually I suggest adding the ABM. I take it off here just for clarity purposes. A lot of times it makes it easier to see the chart. But when you move to intraday, and that's a lot easier to visualize that. From an NQ standpoint, similar situation. Coming back here at the start of the year and produced similar positive extremes, and a little bit later in the run before it produced significant positive extremes. We did have them at the original breakout just after a couple of bars, and pretty much faded away pretty quick. So the Nasdaq definitely had been the more significant leader in broader space, and I think that's where everyone looks at like the Magnificent Seven and that, and they're the ones that really produce the bulk of the returns for the S&P and that. And will they be able to do it in a consecutive year? That remains to be seen. Um, you know, Given the talk of the Fed wanting to reduce rates, you've got to wonder, you don't just reduce rates to reduce rates, other than um, economic activity slowing significantly, which is what the bond market is pricing in here. And we look at a year of the bond market going all the way back here, we saw a significant rise in rates and now a significant drop in rates, which material it doesn't affect what is actually taking place at this particular stage, because the Fed hasn't cut yet. They said they're going to support election year, and we'll see if it happens sooner. But the reality of it is it's going to be priced in. So anything that fails to meet that expectation or become more exuberant could be problematic for a return standpoint for the market. And oil, as long as it doesn't continue to spike, when we look at it from a year basis, pretty well flat. We had some spikes in here, and those spikes did create accelerated inflation areas. We're not going to see a reduction in inflation with where oil is now. You'd have to really have another $20 or $30 drop in it to really start a deflationary cycle, which would be definitely much more problematic than anything. So we also saw the bifurcation this year of oil markets from the east to the west, and the sanctions, and that really have seemingly put more of a strain on Western countries than they did on Russia. So, and then you have that coalition that's created an entire bloc of the East, and how that plays out and the geopolitical issues. We're already seeing some of that in the Red Sea situation. U.S. deploying, forces to help transit shipping. So the potential for disruption in those areas can certainly have a huge impact, and that's something that we definitely watch. You can see from a gold standpoint, starting out the year, hasn't done all that much. It had a few spikes in there, but given what we saw from inflation, you would have expected gold to do a lot better than it has. And part of that is, I think, the dispersion into the crypto space. When we look at it from a crypto space starting the year, big difference between where it is and gold in a relationship standpoint. And of course, there were a lot of traumas going throughout the year in the crypto space with the fraud issues and things like that. But as we move towards the growing view that the adoption of a cryptocurrency and what that means for tokenization for all assets and the government's ability to really shift, you see it in the EU, particularly with this push towards digital IDs, which eventually they talk about, following your every move transaction and that, issuing carbon credits to decide whether or not you've done too much, too little, and, this kind of Orwellian approach to life. But it's just as effective, when you've seen this year debanking, banks deciding that if you don't like things, we're just going to tell you can't bank anymore. And we also saw it with, I believe it was Verizon that came out with their update that says if you put things on private messages that violate their standards, you could be fined. It's an insane corporate world technocracy where they claim the ability to do things at will because they're a private company, and yet somehow it seems to be in concert with the majority of what the government is proposing as far as censorship and things like that. It's a very interesting time, and at some point it's going to have to get dialed back. Otherwise, I don't even know what kind of country you're talking about, at least from an American viewpoint. We already see, I don't know how to describe it any other way than a fascism, where certain companies are approved by the governments controlling things. And what does that do from a crypto standpoint? I think that it continues to excite it. However, I've already pointed out these cryptos in that are only going to survive as long as the government approves of where they're at. The big battle between ETH versus Bitcoin, I should shrink that just a little bit much. That's April and February one more time, and that gets us back to the beginning of the year, which was right in here. And so significant move from an ETH. And of course, the big battle will be whether or not ETH has more utility, blah, 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 blah. There's a whole lot of stories versus Bitcoin and some of the other alt tokens, SRP and everything else. And everyone can get into those debates and the meme coins. And again, those are just your speculative moves, not too different than what some of the early internet stocks used to do when they had their high betas and that. But it certainly lends itself to the question of, how much adoption are we going to be moving to in that digitization? And I think that really is going to be the big push in 24. Be a lot of distractions with the election and everything else. So a lot of different things can happen under the radar that a lot of people really won't be paying that much attention to. When we look at our 50K, you can see starting from the day, straight down. It was pretty clean. We had the spike of the MBI weight right here, and then we dipped below the 25 magic level there. And once it did it again, which was the start of Friday's action, and that was it. And that was enough to drive it down. Didn't take long for the turnaround to take place with the dip of orange below red DOC, and that started the turnaround move. But we did end with a pretty weak signal going into the end of the year. Um, all in all, our action in the signaling for most of the year was spot on. It was really good despite some really interesting events. But needless to say, if you pretty much just had bought at the start of the year and ignored everything that was taking place in the world, it worked out fine. Will that be the case in 24? Probably will do okay. Probably not to the same degree, because usually following a year of these kind of gains, you usually have another 8% or so return from the market. But again, it's an election year, so that's going to create a lot of volatility, and we saw what happened in each of the last election cycles, and the drama that it creates in the futures markets and that. So it's going to be a lot of fun. Looking forward to it. A lot of excitement heading into this year. So we look forward to continuing to provide some solid signaling. I had put up those charts at 5K, and the dip that was taking place is pretty clean. And this is why I like the 5K or even 50K tick charts, simply because we reduce the noise of time. Time is irrelevant when it comes to how algorithms trade their setups and that. But it was a beautiful dip, nice turnaround right above the 23% that led to the highs, and it made a little sell off there towards the end. But all in all, really good stuff, and look forward to the start of a new year, and you'll have indicators all ready to go for January 24. We'll make it a good year. As always, trade well, and hope everyone has a safe holiday.